What's up, gold miners? Today we welcome Kimberly Flynn to the program. Kimberly is the president of XA Investments, an investment management firm that was created with one singular purpose: provide investors like you and me with access to institutional caliber alternative investment opportunities. And in this episode, we go deep into all things alternative investments, starting with the rise of alternative investments over the last decade and why more and more investors like you and me are starting to ditch the public markets and invest more into private opportunities. Later on in the episode, Kim dissects the interval fund, which is a specific type of fund that her management firm specializes in setting up. These novel types of investment funds are partially liquid, and they provide investors with a lot of the advantages of private investments without completely sacrificing liquidity. And finally, we conclude the episode with Kim going over some of the realities of investing into alternative investments, including the varying levels of competency amongst asset managers and sponsors, and the tricks of the trade that investors like you and me can use to vet these sponsors, differentiate the good ones from the bad ones. This episode is an absolute masterclass on alternative investments. Kim is an encyclopedia of knowledge, and you really owe it to yourself to give this one a listen. Lots of nuggets to pick up in this episode. So without further ado, everyone, let's welcome to the program, Kimberly Flynn.
The Gold Mine Podcast.
Kim, welcome to the Gold Mine.
Thanks, Danny. Great to be here.
You know, I'm so excited to have someone with your expertise on the show. You know, primarily up until a few months ago, this was mostly a real estate investment podcast. And what I decided at the beginning of the year was like, hey, we're going to expand our horizons a little bit and get more alternative investments out, but, you know, into the show, aside from just, you know, the traditional real estate plus real estate syndications funds and all that good stuff. So really excited to get you on here and have your perspective shared with the audience.
Well, thanks, Danny. I mean, it all starts with real estate in many respects. You know, I think real estate is like ground zero for people, their familiarity with private markets. Maybe it's the first, you know, type of investment they made. And so I think there's a lot of comfort that people have in terms of real estate investing being one of the first things that they might do. And it leads to other things like private equity, I think.
Yeah. It's like the gateway drug, right? Yeah. It's like the gateway drug. And so you started, you kind of glossed over it there, and you mentioned this before we got on. You started with unlisted REITs.
Yeah, I mean, the industry really, the work that I do now across a lot of alternatives, it all started with non-traded REITs. And there was really a big boom in the late 80s and 90s. Really, you know, it was an opportunity to educate advisors and investors on private real estate. And that led to what came next after the non-listed REIT was the non-traded BDC. And so it's funny that, you know, a few years ago, Blackstone popularized the non-listed REIT and the non-traded BDC, but these structures have been in the market for 20 plus years. And that, for many advisors and investors, was the first alternative investment that they had access to. And a lot of advisors invested heavily in non-traded REITs. And so I think it's funny that Blackstone gets credit, but they were really just dropping the price on a product that had long existed to offer that kind of alternative investment exposure. And it's really led to a lot of really cool things in the private market space today, but it did start with non-traded REITs.
Yeah. So I really want to kind of hear what got you into all of this, because you've successfully listed or launched rather over 40 funds in your career. Is that correct?
Yes. And that was just actually at Nuveen Investments, where I spent the first 12 years of my career. We were launching a new registered closed-end fund every quarter, but Nuveen is the leader in the listed closed-end fund marketplace. At my firm that I run, it's a smaller business, so we're not launching one a quarter. We got to launch it. We got to wear a lot of hats, and we got to make sure it's successful. But part of the business that we have is actually helping other asset managers launch their own products. So my product count goes way higher if you count the asset managers that we've helped bring to market. So it's just a lot of fun doing that product design, solving the challenges of putting illiquid private markets into a product structure like a non-traded REIT that makes it accessible to individual investors. That's the work that we're doing, but we're doing it across all alternatives.
So define, when you say all alternatives, for the listener, right? Like, what does that include?
Yes. Well, it includes real estate. It includes farmland. It includes infrastructure. It includes private credit. And that means it could be direct lending, asset-backed lending, structured credit. We do a lot of work with private equity venture capital firms trying to come to market. So across the private market spectrums, but I think some investors' definition of alternatives might include things like cryptocurrency. Now, I don't have a crypto product, but there's a lot of demand for access to things like gold or things like crypto, which investors might put into the other bucket, into the alternative bucket. And these are all, if we can improve how people buy and trade these types of alternatives, we're opening up access. And so that's what our focus is. And it sometimes it depends on where there's demand. Sometimes it just depends on if our client wants to build something innovative. Last 12 months, it's been a lot of infrastructure, real asset products, partly because of inflation. But you never know where that demand is going to drive us next in terms of what project we work on next.
Yeah, one of the definitions I heard of alternatives recently was like pretty much anything that's not stocks or bonds, right? Like public equities and bonds. Would you agree with that? Or are there other investments that you wouldn't loop into alternatives that aren't public equities and bonds?
I think that's probably the fairest definition. There's plenty of people who don't like the alternatives label because it's not intuitive. It's like, what does that mean? So I think the industry is starting to shift to private market exposures, which only really then excludes hedge fund strategies, which use derivatives and use high degrees of leverage and things of that nature. I'm fairly democratic in terms of the definition. Like, I think anything that's not a stock and bond should be counted. And that's why, there's plenty of people that want to buy crypto, but they want their financial advisor, maybe their advice on how to go about doing it. They're not comfortable setting up a wallet. So I think that there's innovation even on something that's fairly liquid, right? You can buy and sell crypto. It may be volatile. So I think that there's even room there. It's like, where do people need advice or need education? I don't know that people need advice to buy the S&P 500. But I think if you're buying private real estate, you might want to work with an expert in that area, or you might want to get a financial advisor to inform you of the benefits, but also the risks. So I feel like this whole realm of alternatives, it opens up a lot of opportunity, but you're going to have questions. There's going to be things that you don't understand about crypto investing or infrastructure investing. And so I think that's why there's this, everyone wants to get to the individual investor because it's lucrative for their business. So as an individual investor, you have to have a bit of caution, as some of these opportunities become available. So, there's a reason the retail marketplace is growing. We're responsible for saving for retirement. And that means, the responsibilities on my shoulders. I don't have a defined benefit plan. I don't have a pension. And so that's why the industry is shifting so rapidly when it comes to alternatives, because everyone's trying to get the eyeballs of retail investors. And, I think that's opportunity. That's good, but it comes with some caution. I think a lot of people might be overwhelmed as they think about, because, there's a trade-off. Many of these are illiquid. So you're not going to have the same kind of daily liquidity in a private equity fund that you have in your mutual fund or you have in your ETF.
Wow, there's so much to unpack there. I have a ton of questions, but I want to actually, before we go into some of the other stuff, can you define, I'm really curious that you said financial advisor. So can you define financial advisor for me? Are we talking someone like at a big box brokerage firm, or when you say like, hey, they want to get advice from their financial advisor, like who are we talking about?
Yeah, I think if you take a broad view, it could be your tax planner, it could be your insurance guy, it could be your financial advisor. I self-direct on my investments, like a lot of people. And so in that case, you're looking for resource, you're looking for educational materials to make your own investment decisions. But I think there's a lot of, right now, many of these alternative products are only accessible if you have one of those professionals. Like I said, could be a financial advisor, could be a tax planner. And eventually we'll get to the point where there's more direct to consumer opportunities. I know Yield Street, that's one platform that allows direct access. They made a big announcement in terms of how they've onboarded a lot of new alternative investment products. Because like if you have an account at Robinhood or at Fidelity like I do, you can't just go, with a click of a button. You can't just buy an alternative investment.
Right.
And so that's why there are barriers, in the industry. And I think part of it is they're trying to protect investors from themselves. So the industry throws up some of these barriers. Many of the products don't have any suitability restrictions at all. Like if you're talking about the largest category of alternative products right now, the demand and the flows are all going to private credit products, which are, the biggest of which is direct lending. None of those products have suitability restrictions, but a lot of the brokerage firms that you might work with, where you do your trading, they impose their own suitability restrictions that may preclude certain clients from buying those products.
Yeah, and when you say suitability, I mean, I'm assuming that you're talking about like accreditation standards, right? Like,
that's right.
You have to make a certain amount of money, or you have to have a certain net worth, and there's between accredited versus, oh my gosh, now I'm blanking on the different qualified.
QC,
there we go. Yep.
You got QC, you got QP, you got all these acronyms. But if you're a qualified client or qualified purchaser, you can buy any private fund that you want if you're a qualified purchaser. But, with a private fund comes a K1. A lot of people don't want that. You don't want to have to delay your, tax filings because of a K1. And so that's why like having SEC registered products, things that sit alongside your mutual funds and ETFs that don't have any limits or restrictions on investor net worth or investor, asset levels. That's what's important, to opening up this access for a much larger audience of investors. And it's really just been in the last few years. I mean, non-traded REITs and non-traded BDCs, there's also the listed versions of those. Anybody can go buy a listed REIT or a listed BDC because they're exchange traded. So I think that there's been a little bit of the SEC has been overly protective of retail investors. And the reality is that I think with appropriate disclosures, opening up access to every type of individual investor, regardless of net worth, is important, as long as it comes with those disclosures and some education. Because, you can buy leveraged ETFs, you can buy crypto, and nobody's telling you can't. So why don't we let the same sort of access to private equity or venture capital, which a lot of people want?
Yeah, I mean, I couldn't agree more. And I'm actually writing a book on this right now because I feel like there's just like a lack of education out there in the ecosystem. I'll share a story with you real quick. I actually was on, it was about a year ago. I was on the phone with someone here locally who here in Silicon Valley, who flips houses. He flips a bunch of houses here in the area. He also does some ground up development, all single families, right?
Okay.
So single family flips, single family development, and he owns 60 rental properties in Phoenix. And so we were chatting, and I asked him, about his investment strategy. And, he was explaining to me kind of what his goals were and whatnot. And I said, well, have you ever considered real estate syndications? And Kim, you know what he says to me?
What?
What's that? Multimillionaire.
Right.
Very well versed in real estate, ground up development, single family flipper, and also, owns 60 units in Phoenix, Arizona. Has no idea what a real estate syndication is. And so that was my aha moment. I was like, if this guy doesn't know,
right,
how many hundreds of thousands, if not millions, of potential investors, people who would be qualified to invest in these sorts of opportunity vehicles, have zero idea they exist.
I think that's true. And, even if you try to find more information, it's sort of lacking. But I think that if you, the nice advantage, if you are, like the person you're talking about who is a real estate investor, they're going to be a quick study on private equity, because they already know, which is what's great. And that's why it is really the starting point for a lot of things. I always say it's, if people have had the experience of buying their own condo or buying their own home, going through that financing process, it helps you understand like real estate at a much larger level, owning 60 properties, owning a portfolio, and then you take it out to like the Blackstone scale, the B REIT, massive, largest non-traded REIT. So I think a lot of people can pick their point in terms of their comfort and diversification. We did some work on farmland. A lot of people have that same experience of ownership. Maybe they inherited a piece of farmland from a grandparent. In Illinois, where I live, there's a lot of, in downstate Illinois, a lot of soybean and corn farmers. And so they understand farmland investing because they've had that family farm that got sold. And so I think that familiarity is really important. The tangible nature of real estate, you can look at a property, you can walk the manufacturing floor. It helps when you're trying to understand. You understand when you walk a manufacturing floor that property to when you sell it to bring the highest price, you're not going to fire sell a plant like that. You're going to hire a broker. It's going to take 3 or 4 months. And so that helps you understand the illiquid nature, because if you want to, maximize price, you have to have that long, term investment sort of horizon. But the same is true with your home. Like when you get ready to sell your home, you're not going to just put it on the market, hurry up and fire sale it, because you want to maximize the price that you bring when you sell it. So I think that there's an understanding innate with real estate, with farmland. But in mutual fund and ETF land, I want to sell it. I want to sell it intraday. And so that short term, some of that short term thinking, I think people have an expectation of liquidity, want liquidity, but it may or may not be possible with a long duration asset that's higher returning, higher yielding, but you have to hold on to it for a longer period of time.
Yeah. And it really is that long time. That's actually one of the biggest obstacles to getting investors to kind of wrap their head around the idea of investing into, like, say, a real estate syndication or a fund. For myself, is the illiquidity of the investment. And for those who have been conditioned, they can call their broker up, or, like you said, just go on Robinhood, E-Trade, whatever, and, click of a button, they've, liquidated whatever they need to liquidate. So it's a different mentality. And so you're right. It's not everyone's going to be, it's not suitable for everybody, because there's just some people that are never going to be able to kind of come to terms with that. That being said, anyone who's done any amount of real estate investing, direct investments, right, can I think usually get their head around. It's just, you put your money in the house, and at some point you're going to sell it, but it's not going to be tomorrow, right? So that's right. There's a mindset shift there for sure. And coming back to the financial advisor thing, and this is something that I've had a lot of trouble just kind of like dealing with personally, not personally, but just kind of like wrapping my head around, is this idea that, the majority of financial advisors out there, that the big box firms actually have zero incentive, right? I think one of the biggest reasons that we have a lack of education is because the front line, the people that the individuals that people have been told they should listen to, have zero incentive to push private investments.
I agree that they didn't, and they wouldn't. And the only thing that's shifted recently with respect to those, it is a selfish motivation in some ways, which I'll point out that a lot of financial advisors, there's two realms of financial advisory. You have independent financial advisors, RAs, and you have wirehouse advisors, big brokerage firms, a Merrill Lynch or Morgan Stanley. So there's kind of these two worlds. And if you've gone independent, maybe you used to work at Smith Barney and now you've got your own shingle up and you're an RA that's independent. You're running the practice and you're serving your clients, but eventually you'll retire and you're going to want to sell the business. So it's just like think about just like a State Farm or Allstate insurance agency. You've built up the business. You've got all these clientele. Eventually you're going to want to monetize that and sell the practice. Yeah, your dentists, the veterinarian, they all do the same thing, right? They sell their customer list and their client accounts. But with financial advisors, one of the things that as more and more of them have gone independent, there's sort of a rolling up of all these small investment advisors. And so now some of these independent advisory practices are massive. They're thousands of financial advisors. And so that maximizing the sale of your financial advisory practice has led advisors to think about, well, what's our value proposition? And if we're just advising people on stocks and bonds and maybe ETFs, the price that we charge for that advice, it may be under pressure. So that's why a lot of financial advisors have added estate planning, tax planning, other, services for their VIP customers. But moving into private market access gives you a reason to keep your money with a financial advisor, because they're providing that access, they're providing that education, and it makes your client book of business that much stickier. So a lot of independent financial advisors they've long embraced real estate, and many of them have started embracing other types of alternative investments, interval funds, tender offer funds, BDCs. These are all just different ways to access the private markets in a convenient structure, something that gives you the 1099, that gives you some liquidity. That's what it makes it easier for the financial advisor. So I agree with you. If you look at the portfolios of a lot of U.S. investors, it's Mag 7, it used to be FANG, and you go back to like the 1950s, it was a Nifty 50. And so we've long over allocated to the largest U.S. public companies. So we haven't taken, all of the portfolio construction advice coming out of the University of Chicago about optimization of, you should have diverse assets. And it's like, why still do people over allocate to U.S. public equity? Part of it is the fear of missing out on, it's like, well, so I think people accept a lot more volatility from those equity portfolios. Yeah. So I think things are shifting, but there's still that bias towards what's in the press. What do we hear about? Well,
it's, I don't know. I'm going to butcher this quote. In fact, it's not even I don't know the quote directly, but it's this idea that Wall Street's actually it's like the greatest marketing machine of like all time. They like somehow got the entire American public to buy in, and like we've been indoctrinated really. And so, but I do agree with you. RIAs, like I've had a ton of independent advisors who have, proven to me that they are much more than just, like you said, like a wirehouse, right? Like just going straight to like, the public markets or whatever. So I would absolutely agree with you. Like I've seen more independent guys, but the big box firms are still very much like one track mind. Yeah,
they're very model driven. Is the way the one track mind to me is like, well, all the customers get a similar model, and it's like, well, right. Well, what if I do want to invest in farmland or infrastructure? So I think that's really where you've got to, depending on who you go to for advice, you got to ask for this stuff, and I don't think most investors, it's not typically being demanded or pulled by the investor. That's why crypto is one of those exceptions. AI investments are also another exception where the clients are calling up and saying, and a part of it comes from, people who are approaching retirement. They're talking to their kids about what they're interested in. And the next generation, where the wealth is going is to tech, to AI, to to crypto. And so that's why I think there's going to be an industry shift, because they realize that that's where the next generation of wealth is going to be held. And there's expectations by younger investors that it should be easy, it should be accessible, and I should have a lot of choice. And if I want to do it directly or by myself, a lot of alternative investment sponsors, I'll give you one example. Hamilton Lane created a share class that's digital, so that allows people to invest directly through the blockchain. It's a digital share class. It's the first of its kind. Now, the Hamilton Lane underlying fund is private equity. So I think we're going to see a lot more of that to open up access. And, most people they don't have a digital wallet, but in the future, I think they will, because that's what's going to make the exchange and the purchase that much more seamless.
Yeah, no, that's exciting. I actually hadn't heard of that. But I mean, it makes sense, right? Like, how are we going to, like you said, democratize alternative investments? How are we going to make it more accessible, right? Because right now, kind of have to go through people like me and you, which obviously, like, that's great, for us. But so speaking of which, and shifting gears a little bit, XA, your firm specializes in interval funds, tender offer funds. You said BDCs as well. So explain to the audience kind of like what those funds are, like what are the business plans like, and how do they differ, right, from fund to fund?
Yeah. So my firm is sort of unique for asset managers, meaning like when I talk with with clients, I've got two sets of clients. Like I do work with financial advisors, but I also sell consulting services to asset managers, meaning there's a lot of people trying to build these types of alternative products and make them more accessible, but they don't know how to do it, right? It's not as easy as standing up a mutual fund or an ETF. So our consulting practice actually helps other asset managers. Part of the reason is I run a small business. We've got 10 people. And I came from a very large firm. I was at Nuveen Investments for 12 years where I was head of product development. So using what I learned there, I wanted to leave Nuveen and focus more on the private market space. At that time, Nuveen wasn't really interested in doing so. They've now, like every other large asset manager, entered the REIT market, the BDC market, the interval fund market. Our business is about 9 years old, and we do focus largely on interval and tender funds, but that opens up access to all of these different asset classes, meaning there aren't SEC rules about what you can put into an interval fund, and there's not rules on liquidity. Your listeners may not realize, but mutual funds and ETFs, there's a maximum amount that they can hold in securities that are not liquid. And they have to be able to get the portfolio liquid within 7 days. So you can't buy real estate or private equity or infrastructure in a mutual fund or ETF. It is not legally permitted. And so that's why this sort of niche part of the market that's growing rapidly is where I've spent the last 25 years of my career. And it's called a registered closed-end fund. The industry name is an interval fund, and that just speaks to the interval for liquidity. If you're investing in private equity, you need to have a long-term investment horizon. But I also, if it's not a fund with a set term, much of the private fund space is a 10-year term or a 12-year term. Yep. You buy it, and you have to hold onto it for 10 or 12 years. Well, that's not very convenient. What if I have like a 7-year investment horizon? So you can buy a private equity interval fund and you can hold it for 3 years, 5 years, 7 years. And then when you decide to sell based on your preferences and your liquidity needs, then you would sell it at a quarterly interval. So at quarter end, you'd get liquidity. And that's the big difference between a mutual fund, which is a daily in, daily out. You can go in and out of a mutual fund or an ETF. ETFs, you can do intraday trading. But these interval funds that house, illiquid private market assets, you can only go out on a quarterly basis. And then there's a limit. So the portfolio managers provide, typically it's 5% of the portfolio. They get it ready to be liquid. So if customers want liquidity, if more people want out than that amount, then you'd be prorated. So that's the challenge, is that if you, let's say it's April of 2020 and you want out of the fund and you want to liquidate, well, you're going to be prorated and you're probably going to be stuck for a couple of quarters. And nobody likes to hear that, well, I don't know when I'm going to get out of this thing. And if, right. I think as a real estate investor, there's been a lot of real estate investors that have been frustrated being gated or being prorated in some of the non-traded REITs. And part of the reason they do that is they don't, the portfolio managers don't want to be forced sellers. So it is one of the big, trade-offs with these investments. You have the potential for higher return, higher yield, diversification, but there are, specific product features that you're like, hey, I can't live with that, or that's not something I'm comfortable with. And that's a really important trade-off. The whole category of these products is called semi-liquid or evergreen products, because they don't have set terminations. And so therefore you need to understand when you're going to be able to get liquidity and how.
So when you launch one of these funds, right, when one of these funds is launched by either yourself or you're helping asset managers, right, kind of like launch these funds, I'm assuming that these are funds that aren't necessarily like you don't have a hodgepodge of different alternatives in this. It's usually just one business plan, right?
Yeah, usually these funds are single manager, single strategy. Every now and then you'll see like a multi-strat credit product that we've seen. But in the case of like infrastructure, the fund would be dedicated to infrastructure investments. Now it might be multi-sector. There might be some warehouse, might be some, toll roads, airports, things of that nature. So it would be diversified within that subsector. But each of these funds typically presents itself as a single portfolio management team delivering on a single focused strategy. And so that way, as an investor, you can think about, well, do I want a 5 or 10% allocation to private equity? I mean, companies are staying private longer. So, you're missing out on the growth potential. You think about Elon Musk's portfolio of private companies, XAI, SpaceX. A lot of people want access to those private companies, and you can't do it in the public markets. But there are private equity funds in the interval fund market that have exposure to Elon Musk's private companies and a lot of other, unicorns. There's been a lot of enthusiasm around companies that go public at a much higher valuation because they're more mature. And the capital markets have been, with a lot of volatility, the war in Ukraine, and a lot of other, is just the last 3 or 4 years has been challenging for IPO markets. And it's also been challenging for private equity exits. If you can't IPO, you've got to sell the company to another private equity shop or something. And so that's why I think there's a lot more investor demand now for private equity because of this phenomenon with U.S. companies staying private longer.
Yeah, that makes a lot of sense to me. That makes a lot of sense. And okay, so single asset manager, single business strategy. Now, let's put ourselves in like the mindset of an investor, right? What would be some of the advantages? So you talked about some of them, right? Obviously, like partial liquidity or like semi-liquid, right?
Right.
To these interval funds, you've got potential exposure to things that you wouldn't be able to get exposure to in the public markets. What are some other advantages, right, to these types of investment vehicles?
Yeah, I think commonly cited advantages would be like uncorrelated returns. So if you're investing in a long short hedge fund, you're going to have diversification from your public equity allocation, or farmland, has a lot of inflation protection advantages. I think the argument could be made for some energy infrastructure as well. And so people, if they're looking for certain outcomes, inflation protection, more cash flow, higher yields than what I'm getting elsewhere. That's why private credit's done so well. I think a lot of these specific outcomes, the benefits would be more return, less risk, less correlation to public equities. And so I think those are some of the common benefits, but the conveniences are sometimes just as important. So meaning, if it's an SEC registered product, you've got a board that's an independent board protecting shareholders and minding the shop. You also have transparency because there are requirements in terms of portfolio holding disclosures and reporting, audited financials. So you have comfort in that transparency that's provided. You also have tax convenience with a 1099, like we talked about, instead of a K1. So a lot of built-in shareholder benefits and conveniences that actually make it easier to buy, but also easier to hold and then ultimately sell. And, as opposed to holding a bunch of private funds with 10-year term horizons, now if you're able to go into evergreen products, you can reallocate, shift the model that you're, whatever to your optimized sort of preferences. You're better able to do that than if you're going into 10-year term funds. It's a little harder to rebalance with something like that.
Yeah, that makes a lot of sense. Now, on the flip side, though, what would be some of the inherent disadvantages, right, to these types of investments when compared to maybe, public markets and whatnot?
Sure. Well, I mean, like a mutual fund, these are commingled vehicles with a lot of investors, in the same pool. And so as opposed to buying property or farmland where you're a single owner, you're one of many in a commingled type product. So some people might view that as a disadvantage. I think the other potential risk, I think there's a lot of concern about liquidity and timing of liquidity. And we talked about that a moment ago. That's a consideration for investors. And then I think the other consideration is, how do I judge performance for a private market strategy? It's very clear in the public markets, how I judge my equities. I comp it to the S&P 500. The benchmarking and those comparisons are more challenging in the private markets, partly because the information is lagged and there aren't great performance benchmarks. I think with the growth in this part of the market, we'll see more on that. But you're also going to see wider dispersion in performance, meaning the best private equity managers are going to outperform the worst by a very large margin. And so we always think about in the private markets, manager skill and active management being so much more important. And because of that great dispersion. And I think with public equity investing, it's very easy to go passive and do an index ETF because the dispersion is pretty tight between active and passive. But here in private markets, it's much wider. And so your choice of manager is that much more important. And you want to be investing in the best of the best. And so some of these superior managers are going to have capacity constraints. So that's another potential consideration.
Well, what I think one of the biggest issues with what you just said, right, is that often the best managers are not great marketers. They're not great salespeople. Yeah. Right. And so you kind of run into this issue. I'm sure that you've seen this before where, retail investors, they get conned into investing with someone that has no idea what they're doing, but they're just a great marketer, great salesperson. And so how can an investor, grow to be discerning? Like, what are the things that they could look out for or things, that would allow them to, be better judges of like good managers versus not great managers. And aside from track record, which is like really easy to embellish.
Yeah, I agree. Like what I tell people is ask for a copy of the prospectus, which is the legal document, governing or an offering memorandum for a private investment. So, even if you just skim it, they typically have the risk disclosures very prominent, which is what you should start with if you're investing in a new asset class that you're unfamiliar with. Yeah, the benefits are great, but make sure you're focusing on the risks, and they'll be spelled out very clearly in that legal document. So do your homework. Ask your financial advisor if you have one for help. But I think you're right. Like that's why we were talking about benchmarking is challenging. And so some asset managers, the largest, most reputable private markets firms will have a GIPS. It's called a GIPS compliant performance track record. So ask them if their performance track record's been verified, if it's been audited, and ask to see financial statements. So that these are the ways to get comfort, because this is for an SEC registered fund. Audited financial statements are required on an annual basis, but a lot of private fund sponsors will also do audited financials as well, especially if they're not custodying away. And so I think thinking through if it's a firm that you're less familiar with, ask them who their partners are, ask them who their service providers are. You can judge, I think, sometimes a private investment by the quality of, the law firm, the auditor, the custodian that they're working with. And I think that helps when you're new to an asset class.
Yeah. And probably I can almost guarantee you there's investors that are listening to this, their head is spinning and they're like, oh my gosh, like that sounds like a lot of work, right? But on the flip side, I think that like, just like any time that you're doing something new, right? It's going to I feel like these are skills that over time you can develop, and develop a discerning eye to where over time, it's not taking, forever and a day. And also to your point though, right? Like there are advisory firms out there that specialize in placements into these types of opportunities. So you don't have to do it all yourself if you don't want to.
I think you're right. I mean, most people have a trusted advisor that they work with, and that those advisors, both at the firm level and the individual advisor level, are kicking the tires on these investment opportunities, and they go fairly deep into the due diligence, the investment diligence, the operational diligence, the review of the performance track record. And so I think that's the benefit of having an advisor who's going to do that legwork for you.
Yep.
It doesn't mean that you shouldn't be aware of the liquidity provisions, the fees, and some of the risks. I think that's your job. Even if you have a financial advisor, understand the expected return and yield, but also understand what the risks are to that potential return. And then you can ask your advisor questions. And that's, I think a lot of the learning comes from the dialogue that you're going to have with that trusted advisor.
I feel like we could do this for another 2 hours. And I'm so bummed that we are running out of time right now. So I for sure would love to have you on again, Kim. I think this has been great. A couple things here before we wrap up. And first things first, people listening to this show, they want to learn more about XA and how you could potentially help them, specifically fund managers, people or, asset managers, people that are looking to kind of launch fund. How can they get in touch with you?
Sure. So xainvestments.com. You can subscribe to our free monthly market updates there. You can also follow me or XA Investments on LinkedIn. We're doing daily observations, so educational information for alternative investors, and happy to reach out to me at any point on LinkedIn, and I can share with you some of our educational content. We've got a lot of white papers for people who are interested at our website as well.
Love it. Well, Kim, in traditional Gould Mine fashion, we are going to have you leave the audience with one final gold nugget. Take it away.
Okay. Well, with the burden of retirement on your own shoulders, I think that you deserve it, and your portfolio will benefit from private market exposure in a way that in the past may not have been necessary. But endowments and pension fund managers have long used private market exposure to enhance returns and to reduce risk. And so it really is each investor's responsibility to explore this topic more fully in a way that we didn't have to in the past. And I think there's a lot of ways that are going to make it easier for you as the investor to explore these types of private markets opportunities. And I hope that does benefit you and your family. As we all approach retirement at some point, it starts to come pretty fast, especially when you experience volatility like we have this last few weeks. So, thanks, Danny, for having me, and really appreciate the opportunity.
I couldn't agree more. Everything you just said I think, it resonates a lot with me. And yeah, if the smartest people in the world are doing it, why aren't you? Right? If the wealthiest are doing it, the ones that have the most access, the most knowledge, right, the most resources to vet opportunities, if they're doing it, maybe you should too. At least consider it.
You're right. Like if you think about what family offices have long known, private market exposure for them has been well north of 50%. And that they're thinking not just about this generation, it's the next two generations that those family offices want to provide for. So obviously, very long investment horizon. But if you're going to build and accumulate wealth, that's what we want to try to do.
Oh, so good, Kim. It's been a pleasure. Thank you so much for hopping on.
Absolutely. Thanks, Danny.
All right.